I gave you all my fair warning that an outsized move was about to happen. If you've been following along this channel, you would have seen how we were preparing for this unexpected move. And we saw that today, crushing the tech market. So, if you haven't already, go ahead and like this video so that way you could help out with the YouTube algorithm. Also, go ahead and subscribe to the channel, that way you're not missing any of our contents. And if you know anybody that would be interested in this video, please go ahead and share this video so that way people can know what we are doing on this channel. So without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Let's get right into it. Now, we have been preparing for this moment. We saw it clearly on the charts. Now, people could say that, oh, this is all hindsight looking, right? Because, the markets are now closed. How would we have known that this was about to happen? Well, the reality is that we wouldn't know, but on this channel, we like to focus on the risk that is unseen. You see, momentum can continue to increase. It could also pause, and it could also reverse. And what we like to focus on here is the momentum that we see on the charts. We like to take an objective view to the market because we stay away from what the media is saying, because sometimes it could be false. You could see good news being talked about in the market, but then the market pulls back negatively. You could see the reverse. You could see bad news happen that come out on the reports of, whether if it's an economic report or if it's a company report, but then the market rallies. And so this is one of those times where we saw good earnings release on Netflix and Tesla, beating their sales and top line and bottom line revenue, or top line and bottom line balance sheets, and the market tanked. And so we cannot take a subjective view and fit it into our trading system. We like to look at things objectively, because what we see in the charts here is an exponentially growing tech market on the triple Qs. However, what we were observing back here in June was a high on the MACD, which is a technical indicator that tells us momentum. And then we saw another high that took place on the underlying stock. But what did we see happen on the MACD? We saw a negative divergence where the indicator was reporting a slowdown in the momentum, but higher highs in the underlying stock. And so what does this tell us? It tells us that momentum is slowing, that volume is starting to slow down. And so what I like to talk about is to start paying for insurance. You see, when you pay for insurance, you're not wasting your money. You're using it as a strategy to survive. And by doing this, you can survive these wild moves that happen unexpectedly but expected. See what I'm saying? These things happen very unexpectedly. When when the market Q2 earnings was reporting phenomenally well, but it was unexpected in the sense that the market reacted negatively. And so when we hedge the market, we are paying for insurance in order to survive. We use it to lessen the risk and even make an opportunity out of it. And so that is what we've been doing since June, was to continue to hedge. And even though we lost some, our our overall net bias is still to the upside because when you zoom out, right now we're looking at the daily chart, but when we look at the weekly chart, we have strong momentum on the weekly chart. But when we move into a quicker time frame, which is the daily chart, we saw negative divergence. We saw a decrease in momentum. And it was just a matter of time where our thesis would have proven to be right? And so that is what we do here. We like to look at things objectively. And now that we are here at this point, down 2% on the triple Qs, we now need to figure out what is going to happen next, right? We saw the triple Qs move ahead of all the major indices, much ahead of the Dow Jones, much ahead of the SPY, and obviously the Russell, the RUT, the IWM. Now, if we look at the SPY, which is a more looked upon ETF, right? The S&P 500, which is more broad-based and more diverse, right? There is some tech, but you have other things that are weighting this ETF. If we look at the uh, heat map of this, we can see a mix in the indice. We see that healthcare is still supporting to the upside. However, we can see tech completely destroyed. Financials are still doing pretty good. Consumer staples are pretty, flat. We have industrials that are pretty in the mix, and then obviously utilities and energy, which is pretty stable. But we need to look at the charts. What is the charts telling us? Right now we see a doji, right? Which is a wick at the top and the body is pretty flat, opened where it closed, and then you have a wick on the bottom. Soon after, the day after, we have a negative 6.66% move to the downside. Now, can we assume that this downside move is going to continue? I would say yes. Now, all of these things that I'm saying is not 100% certain, but we have to, as traders, we have to make assumptions, right? Where can we figure out a possible risk reward entry given the fact that we've had, several days of historical events, right? We had a top of this overall move at $456.43, right? And then we saw a pullback in the market today. If we assume that the market is going to continue lower, well, I would take that move just because we know that we have a stop right at 456. Now, where can we see that this market is going to trade down to on the SPY? Well, I'd like to take this trending moving average, the 15 EMA of $446 to be a potential buying point at this level. Now, once the market pulls down to this level, I am watching how it will react because obviously we know that tech sold off and there's a big weight in tech in the SPY. If we see an outsized move in the SPY to possibly pull down even further, then I would start looking at different levels of support and resistance. We saw, well, we see right now that a potential would be 444 on the SPY because that correlates back to these prior resistance points, and we'd want to see how the market will trade up to this point to possibly test for support, right? And so that is what we're looking at here on the SPY for a potential buying opportunity. Now, as we know, the triple Qs was destroyed today. So we want to see how things are going to play out at this point, right? So there's a couple things that we need to pay attention to. We have a possible crossover on the MACD that could take place by tomorrow. If this happens, we can potentially see further downside for this underlying ETF. Now, if we are looking for a potential buy, we would probably look at this level here, this 360, and this 370, 371. these are a faster time frame of potential buys that we are possibly looking at. And just by this candle alone, just by the way this candle currently traded, um, I would say that there's further downside because this is not a, you know, this does not give me much confidence of buyers starting to step in at this level here. Even though we have a small wick at the bottom, the body of this is fairly large. And so uh, intraday we might see a potential buy, but I would say that it's going to be quickly followed up by a lot of sellers stepping in to move the market down on tech. Um, and so looking out at a larger time frame, we can start to map out different levels that would be very interesting to look at. So let's zoom this out over here. If we are looking for a potential buying area on the weekly candle, which would be heavily influenced, I would start to look at the 372 because that correlates to this point here, which could test as a prior resistance turn to support. So let's go ahead and mark this here. And whenever you're mapping things out, you always want to use a clean chart so that way you could get a better view of the market and also a better view of how we can identify where buyers and sellers would possibly place their bets. So obviously we failed this level here, or we failed to even test this level here, this candle here back in January of 2022. The market pulled back significantly, and we're now looking to find possible areas of support. So let's look back here. So that's really, I would say this would be the strongest point of the first level of support. If we were to break that support and continue lower and possibly pull back into the mean of this weekly 15 EMA moving average, we could pull all the way down to 350. Now that's going to be a bit of a stretch, but obviously with the way earnings is going, you're getting a lot of surprises, and next week is going to be the biggest week for earnings, and so we got to be careful how the market will react. Another good point that we like to make on this channel here is that as traders and as option traders, we are not here to predict where the market is going to go. We are here to react. And so we want to look at things on an objective standpoint and look at how the market would react at each level and determine whether we can find an opportunity of a low risk, high reward entry. And now from that standpoint and that framework, we could start to build out our trades. And so as of right now, you know, looking at this weekly candle, we do not know how this weekly candle is going to develop. Even though that today is Thursday, we have one more trading day of the week. If this candle forms and closes where it's at right now, that's not going to be a good look for the market because essentially this would be a shooting star candle, which is very negative. It's a negative formation in terms of a reversal candle, especially being its placement here at the top of this move. Whenever you see a shooting star, what typically happens is that you would want to see how the next candle will form, and if it forms, or basically if the market uh, opens and either closes at this level the following week, which would be next week, when we hear all of these earnings, if the market starts to pull down and does not make any attempts to move up, we could see further move to the downside. So that is what we're looking at here. Since we have one more trading day to the week, there's going to be a lot of movement, um, based especially if this candle closes the way it is right now. Things would not be looking so well for the next few weeks because given how explosive this range is, right? the market will always want to pull back to the mean, and it's not going to look good, in the sense that this bull run is going to essentially end for the time being, and we could possibly get some consolidation and move sideways once we hit a ideal support point in the market. And once we move sideways, we're going to want to look either for like some sort of like cup and handle move or a possible double bottom move before we could even move higher to the upside. And so that is the outlook that we are looking at here on the triple Qs. Now let's go ahead and look at the VIX, because this is something that I was closely paying attention to. In fact, if you watch my prior video, this is something that I was pointing out, that if you caught this, you would have made a good judgment call on the trades. So what we have here, since June 23 of 2023, we saw the low of 1273. We also saw a higher low on June 30th. And what I was telling people is that if we start to see a higher low on the VIX, which would basically, indicate the volatility in the SPY, the S&P 500, if we saw a higher low on the VIX start to form, I was telling everyone to be prepared for a possible sell-off in the market. And we saw that today on the triple Qs, but as of what we know right now, the S&P 500 has not, essentially followed through. But we are seeing this higher low starting to form. If we zoom further out, oops, let's go ahead and switch this here. If we zoom further out on the VIX here, let's go ahead and use the 3-year. We have this sloping. Sorry about this here, folks. Let me clear this out. We have this sloping trend line on the VIX, and we can see that if the VIX were to pull in to this level, we could possibly see a high of 15 on the VIX, and that would mean that the market, the underlying stock for SPY, is going to make a move to the downside, and it could be fairly large and unexpected by a lot of traders, and catch many of those who think that this market can rally, in a straight line by surprise. So we need to pay attention to the VIX, because when volatility hits, it's going to be unexpected, and it'll move mainly on headline news rather than the actual, technical levels of the stock. And so things could get pretty crazy in the next few trading weeks or even months. Another thing to point out is that on the weekly VIX, we are starting to see a potential crossover that could rally the VIX higher and induce volatility into the market. So that is something we want to pay attention to. Now, if we move into a faster time frame, let's say the 6-day chart, we are already seeing an increase of momentum shift on the VIX. So we got to look at all of these things objectively, right? I know that the main hype was AI, everything AI. If you said AI, the market went up. If you were Petco and you said anything about that you're doing AI work to feed your pets, that stock would have rallied. So that was all induced. This whole market rally was all about AI. That's going to be a historical event, but in all realities, we got to be prepared for these outside moves, and just know that if you're watching this channel and you're staying tuned, we'll look at this market objectively, and we'll trade it day by day. And the whole idea here is to manage a risk. So please go ahead and like this video. Go ahead and subscribe to the channel. Uh, and I know this was a much longer video, that you had your drink and you drank it well. So once again, we'll see you in the next one. Make sure you subscribe to the channel, hit the like button down below, and we will see you on the next one.